Welcome to the Passive Income Machine podcast, where we show you how to break free from the grind and achieve real financial freedom in 10 years or less. My name is Ryan D. Lee, and I've helped thousands turn income into cash flow, trade fake money for real assets, and take back control over their time, their wealth, and ultimately their life. Each week, you'll get strategy, tools, and mindset to build your own passive income machine. So, my friends, sit back, relax, and enjoy today's episode. All right, my friends. Welcome back to the Passive Income Machine podcast. You are on the microphone today with me, Ryan D. Lee, and I've got my man, the return generating machine, Scott Saunders. Scott, you want to say what's up to everybody?
Ryan, great to be with you. Great to tackle today's topic. Really looking forward to digging into it.
You know what, Scott, the topic of conversation today is an interesting one because a lot of people hit us up and, they always want to ask us, what do I think about this versus that? Would you do this if you were me? What do you think about this investment versus that investment? And I think it's an interesting topic. And, I don't shy away from those conversations. However, you and I both know people that have been sucked into investments, and there's some pretty big ones going on right now that have promised big outcomes, but weren't necessarily capable of delivering those big outcomes. And so today what we want to talk about is we want to talk about what investing actually is. Right? We want to talk about when you're parting with capital, what is the definition of an investor versus the definition of a speculator. So Scott, I think before we talk about what people are facing, let's tackle those 2 points. Let's tackle what is an investor and what is a speculator. You down for that?
I'm down for that. Well, I'll tackle the speculator because that one's an easy one. So speculator all revolves around that whole concept of hope, right? They're going to go ahead and they're going to roll the dice, and they really want a great outcome. And it's like you're sitting at the table there, you're shaking the dice, and you roll them out. That's what a speculator does. A speculator hopes, and unfortunately, with that, a lot of times they're looking for not just ordinary returns. They're looking for extraordinary. They're looking for the home run. They're looking for the really big one, the really juicy deal that just looks so good that if it works, it's going to be awesome. That's what a speculator is. And they involve themselves in a whole wide variety of investments, pretty much anything under the sun. But that's the outcome that they want, is they're hoping for that great return. They're going to part with their hard-earned dollars, and they're going to put their money into something hoping that it produces a great return. Why do you tell us what an investor is? Because this one is the one that a lot of people don't really understand or unpack that much.
Yeah, I think it's really interesting on the speculation side. Before we jump over to the investment side, the thing that kind of strikes me is, in most perceived investments, if we really want to be technical about it, right? If we really want to get down nitty gritty to the details of the definition, most people who think they're investing are actually speculating. Right? A speculator is someone who is parting with capital, as you mentioned, and the only way they get a return of any kind, whether it's 1% or 100%, the only way they get a return is they hope they can resell whatever they've bought at a higher resale value. If you really think about it, that's all the stock market is. You're buying a stock, a mutual fund, a share at one price, hoping that, the economic factors, the company, everything that plays in to the valuation of that stock will cause an increased valuation at some point down the road. And the way you capitalize or realize your return is you have to sell. Right? You have to sell your asset in order to really generate the return. And that's always struck me as weird, right? Because at the end of the day, if you really think about the concept of retirement planning is just future spending. That's all it is. I want a stream of income. And if I have to sell my assets, my mutual funds, to generate income, I'm just building up. I'm hoping that my things are worth more in the future and some dummy's going to buy them for more than I paid for them back in the day, and I'm going to sell them so I can generate income in the future. That's really all speculation is. Are we on the same page there, Scott?
100%, 100%. And you're right. It's the game is I buy it at X price and I'm hoping I sell it at X plus somewhere down the road, right? I'm hoping that comes out there, and I'm hoping that these tailwinds out there will get it there. But it's a hope, and it's based upon one variable, right? I go in at one price, and I'm trying to unload it at a higher price, and that difference is my windfall. That would be my profit, is that difference.
Yeah.
Whatever it is, whether it's up by 10% or 2x, that's what we're shooting for.
We just released our best-selling book, Retire in 10 Years or Less, and I had a screenshot on one of the days Jim Cramer, I guess, released a book too, and I kind of had to chuckle to myself because a couple friends sent me the screenshot of my book next to Jim Cramer's book. Because back in the day, when I was trying to take more control over my finances, I joined a course with Jim Cramer, and he was teaching me how to pick and choose stocks. And it was so fascinating to me because, I would listen to his paid course, his paid recommendations in the present moment, all the due diligence, all the speculation on, why this company's poised for upside and all of these different things. And I remember, he would tell you to buy, and so I would buy, and then he'd tell you to sell, and so I'd sell. And I won some, and I lost some. But at the end of every win, and at the end of every loss, I remember feeling more confused than when I started, because I didn't really know why I won, and I didn't really know why I lost. And I always felt so... I felt, man, what am I doing? How am I ever going to take control of my finances if this is the way I'm playing? And it was the weirdest thing for me in the beginning. Once I started taking more control over my money, it felt like everything was a speculation. Everything was a gamble. But it wasn't until I understood what the definition of an investor was that I started to gain more semblance of control over my money. So, in order to understand this, my friends, let's go back to Warren Buffett, because Warren Buffett says the most simple thing that everyone has heard this, but no one internalizes it when it comes to their money. So Warren Buffett says there's 2 rules of money. Number 1, don't lose money. Number 2, don't forget rule number 1. But then if we take this over to how most people play with their money, they're up and down. They're winning and they're losing. They're speculating all day long. So they're obviously violating Warren Buffett's 2 rules of money. So the definition of an investor building on Warren Buffett's 2 rules of money are someone who parts with capital with the expectation of safety of principal. So they're parting with their money that they could otherwise spend, they could otherwise do something with the expectation that their principal, what they've parted with, will be safe, and they'll get an adequate return in the form of interest, dividends, or rent. That's completely different than the definition of speculation. So, Scott, unpack that a little bit for me as a person who's getting ready to part with my capital. How are the worlds of speculation and investing different now with these 2 definitions?
Well, they're not. First off, they're night and day. One of them, right? You only have one outcome that can possibly work in your favor. With the other one, you've protected your downside, right? Because you're looking at a protected one, and then you're looking at a return that has a yield associated, right? If I get dividends, if I get rent, or I get those things, I've got yield providing it, and I've got my base covered. So I invest as an investor. I take capital, I put it into something. It's protected there, and now it's producing something for me that's kicking off a return. And any other upside that happens in a lot of investments is a bonus, right? I'm now getting that yield that's generated. That's a different way of looking at it, because now it's a yield-based process with a protected base at the very bottom of it. Completely different way of doing it. The other way, you're just hoping that you're just hoping that things work for your favor. And I think you said it really well. You're almost hoping that there's some other person out there that's willing to pay more for it than you were, right? So you're just hoping that somebody magically in the marketplace thinks that this is a good idea, and that's kind of your whole strategy. That's not a really great way to approach investing at all, but so many people do it that way.
It's a win-lose game, right? Some dummy has to come along and buy it for higher than you bought it for. That's the only way the game is won. And that's what causes market crashes, when the dummies get done buying and then things crash, right? And so without going too far down this road, let's kind of course correct and let's pivot back to why we're talking about this topic today, investing versus speculating. We have several clients, like I started this off with, that always come back and ask us, our opinions on things. Now, Scott, I don't know if you want to drop names. I don't want to know if you want to drop numbers, but 2 articles have recently come out with some fairly well-known, prominent public figures that have raised money that are now getting, some hot water that they might have been running some form of a Ponzi scheme. Now, in my mind, a Ponzi scheme just takes us right back to the beginning. And they're willing to go raise money from people where those people are expecting returns that are not even possible. They're expecting something outside of the range of realistic, and so they part with their capital hoping to hit a grand slam on something that they have no business in, no understanding of, and no security within. So, Scott, walk us through why we're talking about this topic today and what's going on.
Yeah, we're talking about it today. Over the last 2 weeks, A couple of these have come to light. So one is a gentleman out in Southern California who's got a fund with, I think right now the issue is something like $62 million. So that one involved people doing some notes, and he hasn't been able to pay them back. So this gentleman has got it. The bigger one is an individual that some people have heard of by the name of Ty Lopez. His fund has something like $102 million of investments that kind of came in, and they're not getting the return. So at this point, we don't know what happened, and that'll work its way through the court process. But we do know that there are hundreds of investors that invested into these investment vehicles hoping for a big return. That was their whole goal, is they hope for a big return. And now they're not getting paid. And so they've gone through the legal system saying, hey, this isn't right. We put the money in. And so I think it's important to kind of talk to people about when you're hearing these things that are out there, how do you make a wise decision? As an investor, we're presented all these different opportunities. And I think you've seen it, Ryan. I know I have. The more capital you make, the more that you have, the more you get hit up with these different opportunities. I mean, I can't tell you how many times somebody said, hey, I've got a really good deal for you. Why don't you look at this? I'm sure you've had the same thing where people approach you with that. So how do you make wise decisions as you're presented with these different opportunities? The last thing we want are people that are listening to this podcast to fall into a trap where they depart with capital into something that doesn't produce that return, or even worse, they lose all their capital and they violate Warren Buffett's rule, right? Which is don't lose your capital. So what are some principles? What are some things that you can think of that would be key to consider as you're evaluating investments?
I think a couple of things that have served me well over the years is understanding that all outcomes require a process, right? And when we skip the process to try to get the outcome, oftentimes we're going to get burned. And, I'll be honest with you, man. I mean, back in the day, this is how I started, right? I'll never forget, and I laugh about it now because it's so dumb in hindsight. But, back in the day, I wanted overnight success. I was so sick and tired of, the piddly returns of my 401k. I read Rich Dad Poor Dad. I went out and did some real estate, and it was like, oh my gosh, this is hard. It's hard. And I want to be an overnight millionaire. I want to be an overnight success. I want everything without any of the process, the work involved. And I remember there was this dude, and it was during the time when America was at war in Iraq, right? And it was a long, prolonged war. And this guy was talking about how you could become quite literally an overnight millionaire. And all you had to do was buy very, very devalued according to, or in alignment with the dollar, devalued Iraqi currency. And when the U.S. government went in and stabilized the Iraqi regime and the Iraqi, economy, then the Iraqi currency would revalue, and you could reconvert your Iraqi currency at a revalued number back into dollars and literally be a millionaire. And I remember I bought 1,000,000 Iraqi dinars. That's what the number is called, Iraqi, or the currency dinar. So I bought $1,000,000 worth of Iraqi dinar. I still have it. And it cost me like $1,200, maybe $1,400. And I remember once a week this guy would do a live show, and it was all about everything that was on the cusp of happening, and tomorrow we're all going to be millionaires. Everything, this got delayed because of this politician, that thing went through, but now the general's going to take over and this is going to happen. And every day for about, maybe 6 months, 8 months, there was this live show, and all these people were on the edge, and I was one of them, like, I'm going to be a millionaire. Oh, not this week, next week. I'm going to be a millionaire. Oh, not this week, next week, right? And now in hindsight, the guy that I was taking advice from called himself the Denar Daddy. So it's the ultimate form of speculation. I had no idea what I was doing. I had no idea what was going on in Iraq. I had no idea how I was going to get wealthy. I had no idea if it did work, why it worked. And so I was 100% gambling. I was speculating, right? And that right there is the problem. I was trying to skip the process to get the outcome. What I've now since learned, I had another mentor early on in the days, Mark Ford. And Mark Ford had a concept that he talked a lot about in his newsletters, where he would talk about becoming wealthier every single day. And that sounds super boring. I want all my wealth right now. I don't want to become a little bit wealthier every single day. But once I settled into and I just accepted the reality that there are no shortcuts, that doesn't mean you have to wait for 40 years. There are economic things you can do to generate wealth faster. But once I settled into that all wealth is a function of process, and I settled into the process, now I can legitimately say over the last 15 years, Scott, I've got wealthier every single day. And in the short run, dude, it was boring. It was like, it's not going fast enough. But now, 15 years later, I'm like, oh my gosh, it's amazing, right? If you can just settle into the process, I think that's step number one. What are your thoughts on that?
I agree. First off, I would say boring is really sexy. We all think the big return, that's really, really cool. But boring and predictable, the older you get, the sexier it gets. You're like, that is a great way to do it. Step by step, a consistent way where you kind of know it because it one year builds on the next. And all of a sudden, after a few years of doing that, you have something meaningful and significant. So I love that approach of doing it, every day, every year, every month, just doing incremental because it leads to something that's really pretty cool in the end. And Ryan, we've all had situations, your situation they're talking about, a Denar Daddy. I haven't heard of that one. That one's a new one. It's a new one on me, but that it's an interesting one. And I've done the same thing where I've invested, sums of money that later on I'm like, why did I ever do that? If I think about how hard it took me to get that seed capital, sometimes it's being really smart. It takes a lot to save up a little bit of money. The amount of effort it takes to work and pay taxes and have that little nest egg, we should treat it with the value it deserves, right? That we actually took time in our life to exchange time, traded it to get the dollars, paid our taxes, and now we got this little nest egg. We should really treat that as something really, really precious, and we should be careful and wise and methodical and think through what we want to do with that. So I think that's a big key. I will tell you, in my life, one thing is you never want to make an investment where you're feeling that sense of pressure. Like, oh, I got to get in. It's closing out tomorrow. I got to do it right away. We've all seen that with things like timeshares. I've been in some timeshare presentations and they pitch you and just always take your time, breathe on it, study what's going on, talk to people. If an investment is telling you you need to jump in right now and you absolutely got to do it right away and it's a once in a lifetime opportunity, right there it just doesn't meet the smell test for me. So I've learned through experience, anytime there's high pressure or hype or some big name or do it because so and so's doing it, a lot of times those investments, they don't materialize. That's been my experience.
I love that. Another thing that served me well over the years is really understanding risk at a deeper level, right? I think risk is a fascinating thing because if we really understand risk, there's this. What was Warren Buffett's business partner's name? It was gosh dang it, why am I forgetting his name? He just
Charlie.
passed away.
Charlie.
Charlie Munger.
Yeah.
So Charlie Munger had this presentation, and I heard him give it a couple times, and it's the oddest presentation because on the surface you're like, what is this dude talking about? But it was this idea of how to have a miserable life. That was the name, the title, the theme of his presentation. And really what he was trying to help you do is he was trying to help you do a process of inversion thinking. If you can think through, because our brains are naturally wired to think through all of the things that can go wrong. It's an easier conclusion for us to come to. So if we can think of all the things that might go wrong, like for example, let's say if I want to go into my marriage and say, what are all the ways that my marriage could be miserable? That's going to be really easy for me to think about. Oh, I could, cheat on my spouse. Oh, I could never pay attention. I could stop, going on date night. I could stop talking to her, whatever, right? All these things. And if I understand all the things that can make it go wrong, then what could make it go great? It's the opposite, right? It's inversion thinking. And what Charlie Munger did in this idea is he helped me understand risk. That risk is really nothing more than the variation from the expected. And if that's true, then most investors, they don't have a reasonable or a realistic expectation of what's possible when they're investing. This is what leads to speculation, because the negative side of risk is when there's potential for an outcome that falls short of an expectation. So we thought we were going to get a 400% return with Tai Lopez, and we didn't get a 400% return. Was that really risky, or did we just have a faulty perception of what was possible? Because the alternative to that is, the upside of risk is we got more than was possible in an investment. I went into a piece of real estate and I thought, hey, I think I can get a 20% return on this. And I think if I manage the expectations, I manage the process, I manage the system, it's highly likely I can get a 20% return. But if I come out with a 35% return, I'm not going to complain about it. I'm not going to feel like I got the downside of risk, but I had positive expectations. I had a realistic view of what was possible, and I got some asymmetric upside. I got more than was expected inside of that investment. Does that idea make sense, Scott?
It absolutely does. It absolutely does. I totally understand where you're coming from on that. And I think a lot of times people want that big return because they need the big return, right? They need it. They're so far behind the eight ball that they're going to need that multiple, 3x, 4x return that's not realistic. And so you got to have a realistic expectation of what the outcome can be, but you also have to go into it realizing that your mindset has to be one where you're taking your capital and you're not going to shoot for that once in a blue moon. What was that? I remember when all the crypto meme things were out, and everything was to the moon. I remember my son was telling me, "Dad, it's going to the moon," and and I watched him. My son actually did that. He actually got involved with all those and was a day trader in college, and was telling me I didn't know anything, and that crypto was the way to do it with these meme coins, and to the moon was his expectation, right? Well, to the moon for most of us as investors, that's not a realistic expectation. It may happen because we're lucky, but as a strategy, that's not a smart strategy. It never is going to produce an outcome. And so many people have that. So I think that's a big piece of it.
Even if it does produce an outcome, you're right back where you started. You don't know how it produced or why it produced, which means you can't replicate it. And if you can't replicate it, you can't sustain it. And so I think that therein lies the problem with speculation. Now, we could go one step deeper on this, and I think we'll kind of leave it right here. The step deeper I was going to go is kind of tiers of operation. In Money Mastery, we're opening up a doorway to start talking deeper about speculation. Now, the reason we're talking about speculation and money mastery is our community inside of this particular organization, they've already achieved financial freedom. They've already got their foundation. It's built on solid footing. And so now you can start to take some asymmetric upside bets, speculations founded on real principles. But now if you win or lose, it's not going to knock you out of the game. And so there are, I think some of the great investors, they're the ones that keep all their chips off the table. When they see something that does have some asymmetric upside potential and it's based on some foundational principles, they go all in. So I think there is some merit to that idea. But here's what I want to come back to and just say on the Ponzi scheme idea. We've known so many people that have been taken by marketing. We're on here marketing ourselves. We're talking about money. We're talking about financial freedom. And I think the critical piece of this is today financial freedom, it's not really investing. It's not money in your bank account because that's going to come and go. It's your financial intelligence. And if your financial intelligence isn't high, you're going to lose money. And that's okay. That's okay. If you go all in, it's going to hurt, right? It's going to hurt if you lose money. But what's the lesson behind the loss? Scott, you and I have learned dude, I've lost so much money. I've lost so much money over the course of my life, right? I've lost so much. But every time I've lost, I've learned. Every time I've bet on Denar or lost in real estate or had something go wrong in a property that I wasn't, anticipating, I've course corrected, I've adjusted my decision-making criteria. Now those losses get smaller. Those losses are mitigated through becoming a better investor. And also, ultimately, at the end of the day, because I understand principles, I put an asset behind everything I do now, which means there's always that stopgap. There's always a foundation. This kind of takes us back to Warren Buffett. Protect the principle, right? If I can protect the principle, I might lose some upside, but I'm not losing the principle, which means upside can come back.
Yep, absolutely.
Well, my friends, there you have it. If we could give you one piece of advice from this, don't be stupid. Don't, follow Warren Buffett's rules, because that's what he says. Don't forget rule number one, don't be stupid. So here's the end of the day. Look, your money, it represents your time. Your time represents your life. Be cognizant of where you put your money, because that is in direct correlation to your dreams, to your time, to your life, to ownership. And our recommendation is get out of the speculation game. Get in the ownership game. It's so much easier. Build systems that build wealth systematically over time. Just like you said, Scott, it's kind of boring, but let's just get a little bit wealthier every single quarter, every single year, every single decade. And if you do that, if you stack up enough little teeny base hits over a long enough period of time, you wake up one day and you're wealthy. That's the game. That's how you play, and that's how the wealthy became wealthy. I mean, Warren Buffett didn't wake up a multi-billionaire. He's been doing this for 3/4 of a century. So with that being said, thank you for listening today. Scott, any final words of wisdom before we close it down?
No, but I think you said it well. Remember, Warren Buffett didn't become rich overnight. A lot of his wealth just came at the very end. And if we keep that in mind, right, he stuck to the principles, we can accomplish the same thing. Absolutely.
All right, my friends, there you have it. Join us on the next episode. And until then, share it with a friend. Friends don't let friends retire broke. We'll see you next time.